All right, welcome. Let's get started. My name is Ben Allery. I'm your host. I am the co-founder and CEO of Blue Jay Legal, and I also hold the Osler Chair in Business Law at the University of Toronto at the law school, where I teach tax law and some other courses as well. But principally, I teach courses in tax law at the University of Toronto at the law school. So it's really my pleasure today to be your host and to talk about how tax foresight can help us to predict judicial decision making using machine learning. And so really the goal of today is to provide some background about how we can use machine learning. It's really meant to illustrate how you don't have to be an expert in artificial intelligence or machine learning to leverage these tools to get really useful insights out of software that will basically help you, that behind the scenes is using a lot of whiz bang technology, but you don't need to be necessarily in a position to understand how those machine learning models work in order to leverage the benefits. Just like if you're doing a Google search, you don't need to know how the algorithms actually function in order to produce useful results using Google. And so this is just going to be about, okay, so how are we leveraging machine learning technology in tax foresight? How does this actually work? How can you use it in your work in order to deliver value to your clients and get to really great answers more quickly, reliably, and consistently? And so I'm going to run through some background. I'm going to provide some context, maybe a little bit of history, and then we're going to get really hands-on and dive into the software and basically analyze together an actual case using tax foresight. So without any further ado, let's go. So the way that I think about tax foresight and related technology, so this is really an outgrowth in our legal system from a development that really kicked off centuries ago with the introduction of mass-produced written materials outlining the law. And so whether that's the case law or modern statutes, I mean, in the tax context, this would have really kicked off with the first income tax acts towards the end of the 1700s, 1798 with Addington's Act in the UK. Pushing right through into the present, really, where we have mass production of written materials, largely analog materials, paper-based materials that we're using to promulgate and make popularly available legal materials, governing legal materials. In the 1970s, of course, we saw a change begin to emerge in how we promulgate legal materials, including tax information. And that was the move towards digital availability of these materials. And at the beginning, it was a very heavy lift because what you had to do was convert those materials, those legacy materials, from analog formats, from paper-based formats into digital formats. So it was very labor intensive to convert all of that accumulated information in law libraries, other libraries, into digital format. And so it's happening very slowly. It's almost complete. Many years of effort have gone into converting all of those materials into digital formats. And now we see, with the rise of exponential growth in computing power, the fact that we've digitized most of these legacy materials, most of the paper-based materials, and we continue to see increases in computational power following roughly Moore's law, right? This idea that computing power doubles essentially every 2 years. What we see is something completely new and completely revolutionary in how we cope with legal information. And this is the computational turn in legal research. And tax foresight is an example of this kind of technology, leveraging the fact that we have a lot of these materials available digitally, and now we have the computing power and the algorithms to analyze these digital pieces in order to get more insight into what the law actually requires in new circumstances. So Whereas historically, you might have made reference to a loose leaf. So this is for the older members of our audience. You might have made use of loose leaf materials, interpretation bulletins, paper-based interpretation bulletins from the Canada Revenue Agency or Revenue Canada, as it then was. We can now fast forward the technology and give you real-time insight into how the accumulated case law and other materials might actually lead to an answer in your specific situation. So this is really quite a dramatic change, and it's something that we're going to be addressing today, of course, in this webinar. Okay, so what does it really allow you to do? So let's think about it from the perspective of someone in tax practice. What does this software allow you to do? Well, it allows you to do a few different things that are going to be really helpful to your clients. One is more generally kind of provide your clients with the highest quality tax advice possible. Now, how does it do that? Well, we're able to analyze all of the relevant case law on the particular questions that your clients may be facing literally in seconds. Now, there's going to be a few minutes of interacting with the software before it delivers those insights, but in terms of how long it actually takes to process your client situation and provide you with insight, it's almost immediate. It's incredible in terms of the speed that it's able to synthesize all of the existing case law. And in some cases, we're talking about thousands of cases that it's basically bringing to bear on your client's tax situation. So this allows for more reliable and more consistent insight into the consequences for your client than otherwise would have ever been possible before. It's consistently comprehensive, it's reliable, you can avoid errors. Many of you are experts already in tax law, so what this also allows you to do is really validate your instincts and gives you the opportunity to double check what your intuition is telling you about your client situation. So the example we're going to talk about today involves a circumstance in which there's a debate about whether certain rental income constitutes income from business or income from property. And of course, this is a bit of a line drawing exercise. What the Act kind of forces onto the situation is an either or, when really the fact situations are more continuous in terms of how they blend into each other. So on one end, you have a very services intensive delivery of accommodation, and that's going to likely be characterized as a business. At the other end, it's more purely a transactional payment for the use of a property, not with very many ancillary services, and that's going to be treated as property. The real question is somewhere in between. How is a court going to be analyzing those in-between cases? And as an experienced or seasoned tax professional, you'll have developed an intuition over time about what the courts would likely do, what the CRA would likely do in those kinds of circumstances. The nice thing about using software like this, machine learning software, is it gives you the ability to really probe just what the boundaries are of those different characterizations. So when is something more like an apple or when is something more like an orange, and just how much wiggle room is there to get the right characterization that your client is hoping to get. And so that leads into the last thing that this kind of approach allows you to do, which is really quantify the risks for clients. So just how much are you biting off in terms of the riskiness of a position you're taking for tax purposes when you want to characterize a particular rental property as giving rise to business income, when it's actually debatable that maybe it really is property income. Now, in most circumstances, for a lot of purposes under the Act, of course, business income and property income are treated the same way, but there are a number of different areas in which it can make a significant difference. Okay, so tax foresight allows you to really unpack this in a number of different ways. We're going to focus in the analysis today on the classifier. So you'll see that's under the answer heading on the right-hand side of the screen here. There are classifiers and navigators. Those are the functions within tax foresight that really allow you to get specific advice on a client's scenario. And so you can go through and figure out, based on assumptions that you make about the scenario, what the likely answer would be in those circumstances. We time permitting, we might also go through some of the search functionality and case finder and case analytics and see just what we might be able to learn by finding cases that match certain patterns in their factual aspects of the case that we're going to be looking at. There are a bunch of different classifiers and case finders that we have in Tax Foresight. We're up into the 20-something issues. So the business versus property, rental income classifier is just one of those areas that we address. We also address the treatment of gains and losses on the purchase and sale of real estate. So this comes up quite a bit, probably more frequently even than the business versus property characterization. The general anti-avoidance rule has a case finder. So if you have curiosities about whether or not the GAR may apply to a given tax plan or an arrangement, you can use the GAR case finder to locate relevant GAR judgments. The residency classifier can help you analyze whether someone is resident in Canada for tax purposes or not. The worker classifier, employee versus independent contractor kinds of line drawing questions come up all the time, carrying on business and on and on. So dozens of these things in the software. And it's strikingly accurate. So one of the things that really characterizes the benefits of using this kind of software is you can get insight into what the courts would likely hold in your circumstance with about 90% accuracy. And so you might say, hey, hold on then, 90% accuracy on cases that actually go to court, that's really challenging to achieve because the cases that tend to go to court are the ones that are closer to the middle. They're more debatable. They could typically go, at least in the minds of the litigants, either way. If you're able to predict 90% accuracy on cases that tend to go 50-50 in court, that's really powerful. And you're absolutely right. One of the ways that we're able to achieve that kind of accuracy is we're using all of the accumulated case law in order to train our algorithms to get insight into what would likely happen in the next case. So instead of the way that human lawyers and human law students and human law professors tend to think about these things, where we're only able to read a relatively small number of cases compared to the accumulated case law on a question, our machine learning software is able to analyze all of the cases that have been decided on a particular point. And so relaxing those constraints on the set of information available to the software is actually very, very helpful in leveraging all of that human experience and judicial experience that goes into making the predictions. And so as a result, with more information available to the system, it's not that surprising that it's able to perform as well as really the best human experts in making these predictions. You might say, you might have a methodological question. You might say, Ben, 90% sounds really great. How do you come up with that answer? And how do you know that it's 90%? And so there are two basic ways that we come up with this 90% accuracy rate. One is based on how we evaluate the algorithms as we're training them. So typically what we do, we start with a large number of cases, all the cases on a particular topic, and then we randomly assign cases into either a training data set or an evaluation data set. So the training set involves about 70% of the cases, and those 70% of the cases are used to train the machine learning algorithm on how courts are analyzing different aspects of fact patterns and assigning them into one kind of treatment or another. So in our case, business income versus property income. We take the other 30% of the cases that the algorithms, as we've been training them, haven't seen these 30% of the cases in reserve, and we strip out the result of the case, and we just preserve the facts of the case, and we present the facts to the trained algorithm, and essentially invite the algorithm to say, okay, what would you predict a court would do in this circumstance, in this circumstance, in this circumstance, and show the algorithm the facts of those cases without actually sharing the result. And we're able to get predictions in those cases and then compare it to what the courts actually did in those cases. And what we're finding is there's about a 90% matching rate between what the algorithm is predicting a court would do in those fact situations and what actually happened in court. And we know that because it's based on what the final core treatment was. So a really, really powerful way of making sure that what the algorithms are learning is actually ecologically valid. So actually valid for the kinds of cases that go to court. The second way in which we evaluate this is as new cases are decided by the courts, we are of course, paying attention and uploading those cases, those facts into the software. And before we update the models, what we do is we assess how well we're actually predicting the new cases as they're decided. And our experience is that we're getting 90% of the new cases that are coming down out of the courts correct as well. And so the software is predicting both within the set of cases that we have random assignment to training and evaluation treatments within the domain of cases that have already been decided, getting it right, but then also out of sample brand new cases that there's no way that the software could have seen before, it's also getting 90% of those accurate. And so those are the bases by which we're making this claim. Now, of course, things can always change. And as the law changes, the model subtly will shift and take into account new regularities, new changes in how the courts are analyzing new cases. So we now have been selling our software, making our software available across the country since the start of last year. And we have many fantastic clients right across the country who are using our software. Many of the leading boutique tax practices, full service law firms are using our software. Big accounting practices are using the software. This is really gratifying to see the spread of the software, and it's really fantastic for what this means for the profession, because it means that clients are getting faster, more consistent advice. It also means that practitioners who are open to learning new methods of conducting research are actually able to leverage the insights from the software to supercharge their practice. So one of the things that you can do is you can really test the importance of different aspects of the case. So if you're thinking about this from a client advocacy perspective, you can really do a lot of scenario testing and understand the implications of taking a different view with respect to different aspects of the legal test that courts are going to attend to, and get a really great prediction about how much it's likely to matter in your particular case. So it's a way to become more sophisticated in the way that you present a client's case, and it's a way to overcome some of the hurdles to having a constructive conversation. If you're seeking to settle a tax dispute in the past, sometimes the experience is that you kind of are at loggerheads with the other side, whether you're in government and you're at loggerheads with taxpayers counsel or the taxpayers accountant, or if you're the taxpayers accountant or taxpayers counsel and you're at loggerheads with either the government at the Department of Justice or with an auditor. This is a way of breaking through those impasses and having a constructive conversation about which facts actually matter and to what extent. And so what we're seeing is actually this is facilitating agreement much more frequently between taxpayers and government on these kinds of issues, because it's a way of laying bare in an objective way what the likely treatment would be of different kinds of fact scenarios as they arise. So what we're going to focus on now is we're going to become super concrete, because I've been talking generically about this at a high level, mostly conceptually. What we're going to do is roll up our sleeves a little bit and get into a very specific research question and a specific set of facts. So what I'll do is introduce this research question. Of course, this is going to be asking and answering whether income from the rental of real property should be considered as income from business or income from property. Now, at a high level, why this is a tricky question is for much of, I'm just talking about how the Act is organized here, much of subdivision B of Division B of Part 1 of the Act, so really sections 9 through 37 of the Income Tax Act, it lumps in income from business and income from property, and so says that the taxpayer's income from business or property is the profit from that business or property for the taxpayer for the taxation year. What we are basically having to figure out, is something income from business or is it income from property? And there are a number of different parts of the Act that mean that this distinction is sometimes important. And one example would be childcare expenses, for example. Another might be home office expenses. There are different implications for some of the attribution rules under the Act. Sometimes this business versus property thing really matters a lot. And this would be the real context in which you'd be asking and answering these questions typically in practice. And so what we're going to do is look at a real case, the facts of a real case, figure out how the software would analyze that situation, and then we'll do some robustness checking and some scenario testing and see how different things that you might say about the circumstance, how they would actually influence the likely result if it were to go to court. And we'll do a live session with Tax Foresight and explore that. Okay, so we're going to look at this recent case, McInnes and the Queen, 2014 judgment of the tax court. And so just to describe, fairly briefly the facts of the case, the taxpayer in this case was an individual, and her goal was to begin and operate a tourist accommodation business. And so she wasn't a land developer. She wasn't in the business of acquiring land and then engaging contractors to build properties. What she really hoped to do was to acquire cottage properties and rent them out to individuals who are looking for short-term rentals of those properties for tourism purposes. In 2004, the taxpayer purchased a rental unit, which was a residential cottage in Quebec. And apparently she made significant renovations to the cottage to prepare it for arm's length renters for the spring and summer season. So of course the cottaging season in Quebec, as in much of the country, is relatively short, and several months in the spring and summer. That was the case here on the facts of this case. Now the taxpayer entered into a partnership with a brokerage business that specialized in brokering tourist accommodations in the region. So you can think about this as a business that really helped to facilitate connecting those who are hoping to rent properties with those who are hoping to rent out their properties. And so basically an intermediary between the parties renting and the parties actually occupying those properties. And so the brokerage would assist the taxpayer by providing services to her client, to her tenants in her property, and basically help facilitate the entire endeavor. Now, apparently the taxpayer would occasionally contract out work, and she had partnered with the tourist accommodation brokerage, but this was just one cottage, right? So it wasn't like she had a full-time employee working for her day-to-day at the cottage. The cottage is kind of self-serve. You'd have people coming, staying for periods of time, and then leaving. And it wasn't a full-time business to actually manage it. And the property rentals were managed by the brokering company. You can imagine if you're an individual who's renting out a cottage that could be quite a distance from your home, it actually is some amount of work to get up to the cottage, and especially if the rentals are short term, to provide keys and other things. Obviously, this brokerage company played a key role in helping to facilitate that. The company was also responsible for attracting tenants by advertising the property on the taxpayer's behalf. She did handle the day-to-day rental matters herself when necessary, but that wasn't required more than a couple of times each year. And finally, the last fact that's going to be important for us as we try to analyze this situation, say, is this more business income or is this more property income, is really the nature of the ancillary services that the tenants of the property made use of. So now apparently the brokerage did make available some additional services such as landscaping and cleaning services, but the taxpayer's kind of core tenant over this time period didn't use any of these additional services. And since the majority of the taxpayer's income came from this one tenant, the fact is, and we can explore this, the fact is, let's see. The fact is that we're going to say that there were no services that were regularly made available to the taxpayers' tenants, at least not in the format that they actually made use of. Okay. So let's see. We'll jump into Tax Foresight now. We'll close this. Okay, so this is Tax Foresight. This is what you see if you're using Tax Foresight. There are tons of different functionalities in the software. These things will look very familiar to you if you are a tax professional. Things like, gross negligence penalties, assessment period, director's liability, GAR, different indirect things, jurisdictional questions, deductions, inclusions. Here we have the business versus property rental income classifier. We're just going to jump in here and get into the classifier. All right, so I clicked on the classifier. Okay, so what you see right now is that there's a brief description. This is a landing page for this. A couple things to recognize. One is the case law here that the system has been trained on was last updated on October 20th, so pretty current. And typically we try to keep this current within 2 weeks of the latest judgment, and a very high rate of agreement with the predictions of this classifier. So our users are really happy with the quality of the predictions coming out of this classifier. If I need help, I can click on the live chat, and someone from the Tax Foresight team will answer your questions in real time. I don't need help at the moment, so I'm just going to click next. And so this is meant to be really quite straightforward to interact with the software. Here, the individual is not a corporation. So what you'll see here on the left-hand side are a series of different topics or different areas of consideration that the courts actually take into account in exercising their discretion on these kinds of cases. The question here, of course, is this income from business or income from property? Of course, this is really a line drawing exercise, right? Because at the one hand, you have something that's requires very active management, the provision of tons of additional services in addition to the land and buildings that are being made available, versus at the other end, something that's totally arm's length and very few services in addition, and something that's really just the payment of money for the use of real property. All of the circumstances of the cases that are litigated in this area really occupy some middle ground, right? So you're talking about where there is some active component on the part of the owner of the property who's receiving the rent, and at the same time, it is real property. So there's clearly some aspect of that consideration that's being paid simply for the use of that real property, the buildings and anything associated with it. So this is going to help us figure out where in that gray area, whether it's going to tip over into property or to business income. And so all these questions are questions that are, in some circumstances at least, important to that determination. So we're going to go through and answer these questions. We'll see what the prediction is from the Tax Foresight software on the facts of this case for this taxpayer. And then we can play around and do some scenario testing and see just how sensitive the results are to different aspects of the facts. Okay, so here the taxpayer is clearly an individual, so we're going to say no, not a corporation. Is the taxpayer in the business of construction, development, or buying and selling real property? No, not on the facts of this case. This individual taxpayer had purchased only one residential cottage, and the purpose was to use that in a tourist accommodation business, but she was not involved in constructing or having a routine of buying and selling real property. So I'm going to say no to this question. Now, if at any point I'm unclear about what the question is all about, I can hover over this little informational dot and it'll give additional information about how to think about the question. And so here, this is saying, this is really getting at whether if the taxpayer had a gain or loss on the sale, purchase and sale of this particular property, would it be treated as business income or would it be treated as a capital gain or a capital loss? So this question actually can turn on the findings of our real estate classifier. So when you're buying and selling real estate, there's this question about whether you're doing so as a trader in real estate or whether it's actually an investment such that you should get capital gains or capital loss treatment on those transactions. You can use our real estate classifier to figure that out, which is a helpful input then into this business versus property classifier. So that's helpful. You can click there and I'll take you right out to the real estate classifier. We know for sure here that the taxpayer is not in the business of being a land developer. So I can just confidently click no here and then click next. Okay, how many individual units owned by the taxpayer rented by tenants or made available to be rented? Here, there's just one. So the taxpayer has this one cottage that she's making available to tenants through the help of this brokerage business. How many of these units were occupied by arm's length tenants? Well, all of them, all one of them, were occupied by arm's length tenants. You might have a question about, what constitutes arm's length, and so there you would hover over this informational dot, and it will explain what would be at arm's length in these circumstances. The evidence in this case is that the taxpayer is dealing, in fact, at arm's length with all of these tenants, and so we can just confidently again say 1 out of 1 of these units are being occupied by arm's length tenants. Are the majority of the properties residential in nature? The answer here is yes, all of them are residential in nature. So we can click next here. Okay, time and labor. So this gets into like how much service, how much effort, how much actual labor effort is involved in provisioning of the accommodation services to the ultimate tenants. And so this gets into, is this more about the services, or is this more about kind of making someone, licensing someone to use real property over time? So is this more of a property transaction or more of a services activity for the taxpayer? So does the taxpayer use the services of a third-party service provider or management company to provide services to the tenants? The answer is yes, because there is this brokerage service that she's using that actually helps to facilitate the rentals. How many full-time equivalent employees work for the taxpayer in the rental operation? So 0. She has just one cottage and it's not a full-time job. So that's known on the facts here. It's not a full-time activity for the taxpayer. Does the taxpayer have employees or agents who are responsible for finding or assisting new tenants on an ongoing basis? Okay, so let's see. We'll hover over here. Responsibility for finding tenants on an ongoing basis includes advertising for tenants, responding to inquiries from potential tenants, doing showings for potential tenants, receiving applications for tenancy, and screening potential tenants. Responsibility for assisting new tenants includes booking and checking them in. So here, I think the answer is yes. This is one of the big functions of this brokerage, is finding new tenants for the taxpayer. Okay, so that is in fact one of the main purposes of this relationship with the brokerage. Does the taxpayer advertise the availability of rental properties in order to attract tenants? Here the answer is yes. I believe, let's see if the indirectly advertising through the brokerage counts. Advertising includes putting for rent signs on the property visible to the public, or placing postings in a newspaper or on an online classified site such as Kijiji or Craigslist. If the taxpayer does not make any efforts to advertise the availability of the property, then please select no. Note that word of mouth is not considered advertising for the purpose of this question. Okay, that makes sense. So the answer, yes, I'm confident, is yes. Does the taxpayer spend time engaging with matters related to the rental units at least once per week? Here, I think the answer is probably no, just because there isn't a lot of ongoing activity, and some of the tenants stay for weeks at a time. So no. So click next. Select all of the following services that are regularly made available to the tenants by the taxpayer or their agents. So we're talking about a cottage property. The evidence is that the principal tenant that the taxpayer had actually didn't make use of any of these services. Landscaping services might have been one of them, but yeah, so none of these things are actually done on an ongoing basis. You could imagine in more of a bed or breakfast sort of circumstance that you would say, okay, in a bed and breakfast, cleaning of the individual unit is done, performing laundry, like for the bed linens and other things is done. Potentially valet parking, maybe not in a bed and breakfast. Food services, certainly in a bed and breakfast situation would be provided. Potentially other things. But here, this is just a straight residential cottage rental. So none of these things are actually going to get checked. So this is enough for us to be able to make a very strong prediction about what a court would do in these circumstances. So one thing I'm going to invite you to do is, as a tax professional, is commit yourself to an answer. Do you think a court would likely say that this is income from business or income from property? And for bonus points, commit to a percentage likelihood that your answer is right. And so if you're thinking this is going to go one way, tell me how confident you are. Obviously, if you're 100% sure, you would just say 100% and then you pick income from property or income from business. If you feel that this is a more mixed case, you might temper your prediction by assigning it a lower probability. While you're committing to that, actually write it down, or at least tell somebody, if you're watching this with somebody else, tell somebody, kind of commit to an answer just for fun. Obviously, there are no consequences associated with this, but I am curious what you think. Okay, I'm going to click compute. When I click compute, what's going to happen is the system is going to take all of these responses to these different factual dimensions of the case, compare those with all of the previously decided cases by the courts, and come up with its best prediction about what the courts would do on these particular facts for this taxpayer. Okay, so again, this is one of these more borderline sorts of cases, but on these facts, the prediction is that a court would say this is income from property. There's not enough going on here to say that this is income from business. And this result screen is really informative. So quite apart from this prediction at the top end, which is, okay, if the question is business versus property, most likely, kind of like a 3-to-2 ratio of cases with these facts would go property versus business. Right away, we can see that we're being invited to consider different possibilities. For example, so the first what if is, what if the taxpayer's business involves developing or selling real property? So what if the taxpayer is actually a land developer or is a real estate agent and buys and sells lots of properties? What would that do to the likely result here? We're invited to find out. One click, we can click that and find out. We'll do that in a moment. I'm not going to do that just yet. We're invited also to find out what would happen if the taxpayer doesn't have employees or agents responsible for finding tenants. So what if that brokerage company is not actually involved in this circumstance? What would happen to this predicted result? One of the things that we know from talking to the many hundreds of folks that we have using the software on a regular basis is that it's not enough just to get the result. So one of the key things that folks make reference to is this explanatory text here. And so this explanatory text really is a way of making sense out of that prediction here in this circumstance, that it's income from property with 62% probability in light of the specific facts as we've entered them into the system here. So this is a tailored explanation for this particular fact situation, and it's a way of essentially interpreting or getting insight into what's driving the algorithm to make this prediction. So it's a plain text explanation. It's a way to diagnose, is the system actually making sense out of the situation as we presented it to the algorithm. And you can read through and spend some time analyzing this, and it provides helpful guidance. One of the things that our users really appreciate is the unearthing of similar cases. So here we'll see, interestingly, no surprise, the most similar case is McInnes and the Queen, which is precisely the case that I mentioned we're going to be analyzing here. So the way that we've answered the questions in the software actually matches up pretty closely with how the software understands this case. And so you'll see a bunch of similar factors there, nothing that's really different. If we move down, we see the next most similar case is a case from 1978, a relatively obscure case from the Tax Review Board. Close facts, though, also the same results, finding that it's property. You can kind of scroll down and you can see at a glance the degree of similarity between each of these cases. And what's cool is that you see that the 6 most similar cases all went in the direction of property, but then the next 4 cases actually went in the business direction. So one thing that you might do if you're interested in this is say, okay, so what is it specifically about these cases that seems to be different? One thing that I'm noticing is that the taxpayer in that case was a corporation, and the zoning of the property was different. There were also many more individual units. So those things are likely important distinguishing features of that case that went in the business direction. Scroll down further and I can see that there are additional references. These are important references in this context in figuring out this distinction. These are some of the most important generally appellate cases in the area. The Exchequer Court is, of course, the precursor court to the Federal Court of Appeal. The Supreme Court obviously is an important court here. It's the apex court in our system. There are other cases here, some references to the Income Tax Act, and then some of these interpretation bulletins from the CRA. One thing that a lot of our users do is they use the report functionality in the software. So if I click on report, the system is going to generate all of this information for us in a single PDF, and I'll be able to download that PDF and save it to my client's folder. So if I want to make this available in the future, if I want to do kind of archive this for the purposes of showing that I did my due diligence as an advisor to my client, I can do that and save this PDF. It keeps all the specific questions. It's time stamped, date stamped. It has a unique identifier in case I need to pull it up. I can also go to my history sometime later and find this scenario that I ran. So this is really, really powerful. Let's start doing some scenario testing. I actually see somebody's asked a question. So let's see if I can answer this question. I might have to get out of full screen here. How would the result change if the taxpayer was a corporation, given the prima facie assumption that corporations carry on a business? Well, let's see. So we can actually test that. So someone's asking specifically about how this result would change if we were dealing with a corporation. So let's see. So I've just gone back and I can manually do this at any time and just analyze the aspect of my choosing. I changed this question 1.1 from no to yes, and that's a simple matter of clicking recompute, and all the other answers in this dialog are remaining the same for the purposes of this analysis. I can click recompute and find out. Okay, so if you remember, I believe the prior prediction was that it was 62% likely to be property. This has nudged it only slightly back to 59% likely to be a property. So it has the expected directionality of the shift, but it's not a huge shift at all, right? It's 3%. And so what that suggests is that the fact that it's a corporation is not it's not a huge factor inclining the courts towards characterizing this as income from a business. So that would not be enough. You can't simply just incorporate this property and say, okay, no big deal. Now it's for sure a business, because that's not consistent with what the courts have done in the past. And so it does nudge you in the right direction, but it doesn't quite take you there. So let's go back and change that back and just verify my memory that it was 62%. Yeah, 62%. Okay, so now we're dealing with the individual. What if we say, okay, so it's not the case that this taxpayer's a corporation, still an individual, so I've changed that back. What happens if we have an individual who is actually a land developer? So let's suppose this individual was a general contractor and had made a business out of developing and selling real properties, and for whatever reason had decided to rent this property out. Let's find out. I'll click find out. Wow. Okay, so that is a very powerful indicator that this that the rental income received would be characterized as income from business. So if you're dealing with a taxpayer who otherwise carries on a business of buying and selling properties, or is in the land development business, that's very likely to treat those rental receipts as income from business. And you can understand why. There's a provision of a lot of services in developing property, selling property. Those are very labor intensive aspects. So that's a very powerful indicator that those rental receipts would be characterized as income from business. So let's switch that back. Okay, so now we have, again, just this individual who's not engaged in developing properties, not a general contract, not a real estate agent, not buying and selling lots of these properties. What if the taxpayer does not have employees or agents responsible for finding tenants? So what if we didn't have this brokerage company involved in trying to find tenants for her? Would that change the analysis? So what it does actually inclines it more towards income from property, kind of the expected effect here, because that seems like it's more of a longer term holding likely, and just be likely to be a stream of income coming in from the ownership of that particular property. So let's change that back. Now, what if I were wanting to advocate for my client? There might be some things, like let's suppose property isn't the result that I would have wanted. I might want to drill down more on the cases that came out in the business direction. And so I might want to limit the similar cases to just those ones that came out in the business direction. So I can do that, and then I can hover over and try to find those cases that look like they really match up as well as possible with my case. So this might be a good one for me, because what's similar is the taxpayer is not in the business of being a land developer. The zoning of the property is the same. There's only one individual unit that's occupied arm's length tenants. So very, very interesting. So I might want to go to that case, read that very carefully, and figure out, okay, so what is it about this specific case that led the court to say that that was business? I can mine that case for insights and things that might be leading the court in that direction. So it's not like I get this result, 62% income from property, and then I'm done my analysis. I don't have to think about it. What this suggests to you is, oh, you're at risk. If you don't like this prediction, your client's at risk of not liking the way that their situation will be treated by the government if and when it's analyzed by an auditor. But what you could do is say, okay, given that that's the general treatment, what hooks can I find in similar cases to say, well, this case, notwithstanding the general treatment, I think this case is very similar to this Glynn and the Queen case from 2007. I think I'm going to take the position that our case is very, very similar to Glynn, and so that's going to be the basis of this. Plus, if it's 62% likely to be property, that's very close to the borderline. Maybe there's something that is not coming out really in the facts that this case has in common with some of these other cases that we should really be fastening on to. So it's a resource for figuring out how to advocate for your client as effectively as possible. Okay. The other thing I can do to find more cases is click on the Find More Cases button here. And what this is going to do is take me out to the case finder. And so this is going to make available for me all of the cases in this area. What I might do is actually just clear all of these things so I can show you from scratch how I can use the case finder. But maybe I can find all the cases where there is no business of developing or selling real property. Maybe I want to find all the cases where the outcome was income from business. Okay, so I can scroll down. There are tons of these cases which got business treatment, even though there is no underlying land development business. And then maybe I want to find all the ones where there's just one rental unit involved. Minimum of one, maximum of one. So as I do that, it's going to update. Okay, so right away, I know that there are only 2 cases in the data set. And so one is familiar. One is this Glynn case that we already saw on the result screen to the classifier. There's this other Valak SA in the Queen case that we didn't see, where it was an individual taxpayer. The taxpayer was not in the business of being a real estate agent or a land developer, and there was just one unit and it was treated as business. So what I would want to do is, in addition to the Glynn case, I'd probably want to read very carefully the Valak case and find out what specifically about the Valak case is it. And so reading Glynn and Valak together, I'm going to be arming myself with potential arguments about how to get business treatment for this taxpayer. On the other hand, maybe for whatever reason, I want to argue that this is income from property. And so I can, at a glance, very quickly, just with one click, switch that and find it. Now there are 6 cases where we have a taxpayer who's not a developer, where there's just one unit involved that went to court, that went in the property direction. So I can use these cases to figure out, okay, so what is it about these cases that I could fasten on to reinforce my argument that this taxpayer should actually be treated as having income from property. So this shows you really, really quickly how you can work with the classifier to get a general sense of what the likely treatment of a specific set of facts would be in your circumstance, and then as well use the case finder functionality to drill down on those specific cases that share those features in common. Here I'm really saying, okay, the key things are the fact that there's just one unit involved, and that the taxpayer was not a sophisticated buyer, seller, land developer. So if you have a private individual who's not really in the real estate industry and has just one unit, what's the likely treatment? At a high level, it's likely to be property. There are a couple circumstances where it went in the business direction, so it's not a complete no-brainer, and you can go and start really drilling down so you can give your client comfort in the position that you're taking. And you can document all your work really, really quickly using the report functionality once you're happy with all of the answers and what you're learning from the software. So it really is a resource to drive you to the most compelling and convincing analysis possible. So this, kind of circling back to the start of this, right? So what's so different about this? Well, think about the software as replacing a giant library, a giant law library full of books involving many, many cases. It's very difficult to find. It'd be nearly impossible in the course of a day to find, for example, these 6 cases in that library. Even the best research tools, digital libraries, it's very difficult to find cases based on the key facts. So you'd have to read through hundreds and hundreds of cases to find these 6 cases that went in the property direction with just one residential unit available. And similarly, the 2 cases that went in the business direction with just one unit, there's no other way of finding those cases using existing approaches, either in a physical law library or even the digital libraries that are available, because things just aren't cataloged in that way. So the case finder is extremely powerful. When you pair it with the classifiers, you can get a ton of insight into what the courts are doing in related circumstances and really give your clients phenomenally good advice. Now, I just brushed the surface of what the software can do here. There are, of course, all of these different areas of analysis that you can do using the software. What's really nice about this is the software is set up to link to TaxNet Pro. So if you're a TaxNet Pro user or subscriber and you're in TaxNet Pro, if there's tax foresight functionality for the particular issue that you are researching within TaxNet Pro, there will be a reference to tax foresight. If you follow that link out, it'll take you to the relevant functionality within tax foresight. Really powerful way to find that additional insight that you can get using tax foresight that we've been talking about today. Likewise, if I were to click on any of the cases within tax foresight, it would take me out to that case on TaxNet Pro. And so tax foresight and TaxNet Pro work hand in glove very, very well together. Let's see, I'll jump back into the PowerPoint here. As I said, this is just scratching the surface of what the software can do. You might be thinking about a particular case that you're working on right now or been working on recently. Maybe you got a judgment from the courts that you think was wrongly decided. Maybe you'd love to walk through that and test it out with one of our customer success lawyers. Feel free, send us a text to 416-564-4696. You can have a personal walkthrough. You can run through that particular case that you have in mind. You can send us an email, info@bluejaylegal.com. We also are working with Thomson Reuters. So if you're interested, you have a good relationship with one of your Thomson Reuters reps, you can reach out to your Thomson Reuters rep directly, and they can hook you up with all the same information as well. So I do see that there's one additional question here. Oh, yes, somebody's asked, is it possible to get a personalized demo? Absolutely possible to get a personalized demo. That's exactly what I'm talking about. So please, person who asked this question, please go ahead, send us an email or a text. We'll be happy to walk you through the software and show its power for you. I think we're going to wrap it up here. We're basically out of time. Thanks very much for your time and attention today. It's really a pleasure to run you through this and give you a sense of what it's like to use machine learning to get insight into tax situations. Please send us a text, send me an email, and if you're already a subscriber, thank you, and hope to see you at the Canadian Tax Foundation Annual Conference. If you are there, even if you're not a subscriber, drop by. We'll be happy to run you through a demo while we're there. We're sending a full contingent there, so hope to see you there. Take care. Have a great day.